Welcome again, and thank you for joining another Self-Directed IRA and Solo 401k Q&A session. We do look forward to these sessions every month, and my name is Natalie with Sense Financial. We are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. And today I am here with Brett Synicky. He will be answering all of the questions today. Quickly, just going to introduce him. Brett is a solo 401k and self-directed IRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing and is also a licensed California real estate agent. And his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. Thank you, Brett, for joining us today and answering questions.
Absolutely. Thank you for having me. And you said each month, but now actually
Yes.
we're doing this bi-weekly now, every 2 weeks. So please tune in. We felt like it would help our clients a lot and prospective clients as well with just doing more Q&A sessions. So we added another one each month instead of monthly. It's bi-weekly. So look forward to seeing each of you every couple weeks or so. Ben, good to see you again, my friend. Sheila, thank you so much for confirming you can hear us. And Natalie, let's jump right in. But before we do, just one thing. We are not here to provide legal or tax advice or accounting advice. Please seek out the proper professional. This is educational only. We want to provide value in the sense of you being able to take this and have those conversations with the proper professionals and make an informed decision about your specific situation, which, by the way, we are always happy to discuss offline, one-on-one. You can very easily schedule a consultation with me and just have a private talk. All right? Okay. I'm out of the way now. Let's answer questions.
All right, first question that we have is from Gloria. She's asking, can a solo 401k be changed to a self-directed IRA?
Gloria, yes. Thank you so much for the question. Absolutely, yes, it can. In fact, just generally speaking, the rules for 401k going to IRA is fine, right? It doesn't have to be self-directed, but the rules are the same, whether it's self-directed or not. The reason, if I were having like a private consultation with you, I would start by asking, what's in the solo 401k? What do you wish to continue investing in? And if alternative assets either exist or you want to continue having access to alternative assets, then it would need to be a self-directed IRA. Otherwise, if you're like, yeah, you know what? I have a property. There's a rental property inside the solo 401k. I'm at retirement time. I'm going to close up my business, so can't have a solo 401k anymore. But I'm really not interested in managing alternative assets. I just want to throw my money in the stock market. Well, then your option would be liquidate the asset, that rental property inside the solo 401k, and then you can transfer the cash to an IRA. Again, that IRA could be self-directed, or it could be just an IRA at Vanguard or Fidelity and go into the market. So the short answer is yes, with some nuance depending on your situation, Gloria. Thank you.
Okay, next question here is from Jonathan, and he's asking, can you explain mega backdoor conversions to Roth steps and the mega door backdoor contribution limits between profit share and voluntary after-tax contributions?
Yes, I can. And I think there's a couple of questions around this, so maybe we can try and knock them all out with this. So essentially, there are 3 buckets that you can contribute, right? There's pre-tax, Roth, and what's called voluntary after-tax. And they are 3 different types of funds. Of course, pre-tax is a tax deduction now. It grows tax deferred. You're partnering with the IRS because when you take the distributions at retirement or before retirement or whatever, you're going to incur the taxes, right? So they allow you to have this plan that grows tax deferred but is taxable at retirement time and distribution time. Roth, of course, you're paying taxes today on the seed, but not on the harvest. It grows tax-free, and the distributions are tax-free as well. We should all strive to have as much money in Roth as possible. The voluntary after-tax is an employee contribution. Okay, now this type of contribution can typically be done at a group 401k, like if you worked at Walmart and participated in their 401k plan. If it has a Roth component to it, they should also allow the voluntary after-tax contribution as well. And again, it's on the employee side, not the employer, not profit sharing. It's a form of elective deferral on the employee side, but it's not called elective deferral. It's called voluntary after-tax. This money is, again, it's not pre-tax and it's not Roth. It's after-tax. So it stays on your taxable income for the year, but the maximum goes up. So the reason it's called a mega backdoor Roth is because an IRA, a Roth IRA contribution is $7,000 for 2025. Roth traditional is just $7,000 altogether. It's mega because it goes up to $70,000, right? If you're under 50, the maximum contribution to a 401k is $70,000. If you combine the elective deferral, which is $23,500, with this voluntary after-tax, you can go all the way up to $70,000 in contributions. Now, the reason it can be beneficial, besides just getting more money in Roth, and I'll explain how it gets into Roth here in a moment, is because typically without this voluntary after-tax bucket, you only have your employee contribution, also known as elective deferral, and your profit sharing contribution, also known as employer contribution, okay? And the employer contribution or profit sharing is a percentage of the income, right? 25% of the W-2 if you're S Corp, or 20% of the profit if you're filing as a sole proprietor. And so it takes a lot of money, $250,000, $300,000 or so, to get up to the $70,000 when it's a percentage like that. And when it's not a percentage like that, you can do the voluntary after-tax contribution, and it's not a match, it's not a percentage either, it's just dollar for dollar. So you can make a lot less money and actually get up to the you can get up to that $70,000. And so it's very it can be very beneficial if you're willing to incur the taxes this year on the seed for that money instead of having it just be a percentage. And let me, this sounds complicated, but it's not as complicated as it sounds. The way it gets into the Roth instead of just this voluntary after-tax bucket is by doing a Roth conversion on it. Okay, so let me back up a little bit and explain what a Roth conversion is. And by the way, I did a webinar on this that took about 40 minutes, 45 minutes last week. So you can find this on our YouTube channel or in our on our website under resources and then webinars. And I go into all of this in a lot more detail than I have time here today because we have other questions to get to. But a Roth conversion is essentially taking pre-tax, or in this case, after-tax, voluntary after-tax money, and turning it into Roth. It is a taxable event because you're going from, for the pre-tax money, you're going from pre-tax, tax-deferred, traditional type funds in a 401k or IRA for that matter, and you're turning them into Roth, which of course has to be added to your taxable income. You're going to get a 1099 for that, whatever that dollar amount is, okay? For the after-tax, it's already taxable income. It's not pre-tax income, but you still have to do the Roth conversion on it. So if I put in $23,500 of pre-tax money, of Roth contribution straight through the front door, it's not a back door, I'm going to get a 1099 from the solo 401k for that $23,500. It's Roth money. It's not even a 1099 because you're not doing a conversion of any sort. You're just reporting it on your tax return, your 1040, as a Roth type contribution. So it's already part of your earned income. When you do the conversion of this after-tax money, then you have to account for it on your tax return. So that's where the 1099 comes in January to reflect that dollar amount of this after-tax bucket. Now, when you do this conversion, you do it immediately because you don't want any interest to be earned, because that now becomes more taxable income that you have to pay. So it's kind of a simultaneous thing. You make the after-tax contribution, convert it to Roth immediately, and then in January, you issue yourself a 1099 from the solo 401k plan, because you're the plan administrator, so you take care of this with our assistance, of course. And then that's how it gets accounted for on your tax return as not only income, but also now it's Roth funds. So we have articles in our client portal that explain this step by step with all the tools you need. We also, as I mentioned, I also did that webinar last week that goes into a lot more detail of Roth versus traditional and what all of this means. So Natalie, hopefully we knocked out a couple of the questions with that answer.
Mm-hmm. All right, next question here is from David. What is the cheapest and easiest way to make my Roth IRA and traditional IRA self-directed? I want to take my 401k out of John Hancock.
Well, it depends on what you want to invest in and what your goals are. So there are two types of self-directed accounts. There's ones that have checkbook control, and there's ones that have no checkbook control. And we at Sense Financial, we only offer plans that have checkbook control, which allows you to, in the case of the 401k, not have a custodian at all. And in the case of the IRA, we actually bypass the custodian using a special purpose LLC that you are the manager of, but the IRA is the owner, and that is how you have checkbook control, because all the assets are inside this LLC that you control on behalf of the IRA. So if you're going to do a lot of transactions, I wouldn't even say a lot. If you're going to do more than a transaction a month, give or take, and you want this control of just being able to easily write a check or do a wire transfer, online bill pay, whatever it is, then you want that checkbook control. Otherwise, with what I call a basic IRA, you actually have to go through the custodian for all transactions. The custodian signs on the dotted line on behalf of your plan. The custodian is on title to all assets for benefit of FBO, your IRA, or your 401k. And furthermore, there is a requirement per law that the IRA has a custodian. So we have to bypass them. For the 401k, there is no custodian requirement. So we can give you checkbook control right at the plan level. Okay? If you go to one of these basic IRA or 401k, it's not even basic with the 401k because there is no custodial requirement. But if you go to the basic, no checkbook control, custodial IRA, the benefit is you'll pay a little bit less up front. The downside is over time, a couple years usually, give or take, you're gonna more than make up for the cost with the transaction fees and the time delays and kind of the pain, to be honest with you, of going through the custodian for all transactions. So it really depends on what your goals are. If I were talking to you one-on-one, this is part of what I would talk about with you and kind of guide you from that perspective. So hopefully that helps.
Okay, a question from Ashley. What are the two contribution options?
Well, I assume you're talking about, actually, I don't know what you're talking about. Let's talk about traditional versus Roth. If it's traditional, I kind of already mentioned this. It's tax deferred, right? You're getting a tax deduction for that contribution. If it's Roth, you're paying taxes on it today, but never again. So I assume you're talking about that, but you might also be talking about in a 401k, the employee elective deferral and the profit sharing contribution, which I feel like I already explained fairly well when we were talking about the mega backdoor Roth. One comes from the employee side and one comes from the employer side, because being self-employed, you wear both hats, right? You're the employee of the business. As far as the solo 401k is concerned, you're also the employer. So the IRS allows you to contribute from both sides. Okay. So if that doesn't answer your question and you're here, go ahead and clarify in the chat, please.
Okay, next question is from Michael. Can funds from my 401k be used for AI ventures, such as investing in the creation of apps or tools to be sold online?
Yes, it can. So the 401k can be invested in anything that does not involve a disqualified party or collectibles. So everything else is allowed. You might not want to do it if it's going to be the owner of an active business. So, for example, if your solo 401k or IRA for that matter owned a Buffalo Wild Wings, all the income from that business would be subject to unrelated business income tax. It's not a passive activity. 401ks and IRAs are designed to be invested passively, right? Stocks, bonds, mutual funds, ETFs, or in the alternative asset world, private lending, real estate, buy and hold, cryptocurrency. These are examples of passive investments. So it depends on what you're talking about when you say, invest in, what was the exact verbiage, Natalie?
They want to use it for AI ventures to invest
Yeah,
in creation of apps.
so you could do that if you're just going to be like the lender, right? Like an angel investor. Absolutely, all day long. If the 401k or IRA is going to have an ownership interest in that, talk to your tax advisor, because that's probably going to trigger UBIT tax that you need to be aware of, that the 401k or IRA has to pay, not you.
Okay, a question from Cheryl. I am an attorney and have friends who want SEP IRAs. I would like to refer to someone and work with them.
Oh, well, we appreciate that. Hopefully we can be the winner on that search. So first off, we don't do SEPs here at Sense Financial. We do solo 401k and checkbook IRA. Both have checkbook control. If somebody is self-employed and they have no full-time W-2s outside of themselves, the business owners and their spouses, the solo 401k is the superior product over a SEP in a lot of ways. I'll bullet point at least one of those. The SEP IRA has a profit sharing component only. The maximum is the same, $70,000 for 2025. But the solo 401k has elective deferral, employee contribution, and the profit sharing. So with the solo 401k, you get to the maximum of $70,000 much faster than you would with the SEP IRA. Plus, all that mega backdoor Roth stuff we talked about is not available in the SEP IRA. Secure 2.0 allows SEP IRAs to be Roth, but they aren't. Nobody offers them. It's just not a thing. So there's no Roth component. Technically there could be a Roth SEP IRA, but it's not going to have traditional and Roth built in. So you're not going to be able to do these Roth conversions and get creative with that. And also, it's an IRA, not a 401k. So again, we have this issue of the custodian. You can either have that basic setup where you go through the custodian for everything, and you can have a self-directed IRA. You can have a self-directed SEP IRA, or you could just have a solo 401k and have the checkbook control without the custodian requirement. So it's simpler to have the 401k. Furthermore, I will say this. There are some instances where a SEP makes sense. Depending on the time of year you're considering making a prior year contribution, the SEP is a little more flexible later on in the year than the solo 401k is, when, again, you're trying to make a prior year contribution. So sometimes it makes sense to start with a SEP, and then you can just create a solo 401k adopted by that same business, and then roll the money into the solo 401k and eliminate the SEP. So there's some nuance there. Again, we don't offer the SEP IRAs, so that's, you'd have to go somewhere else for a SEP specifically.
Okay, next question is from Jagannath. He's asking, buy an investment property Bitcoin with solo 401k?
Yeah, I read that earlier, and I'm not 100% sure what the question is. If you are here, Jaganeth, I'd love to get some clarification on that. Now, if you're talking about, this is what I presume the question is: 401k owns Bitcoin. You want to use that Bitcoin to buy real estate. That's what I think you're asking, because there are some title and escrow companies that will facilitate Bitcoin transactions instead of just, good old fashioned cash for real estate purchases. If that's what you're asking about, there's really nothing stopping you from doing this. It's a little bit out of my realm of comfortability because I'm not an expert in Bitcoin per se, or crypto for that matter. I know enough about it to be dangerous when it comes to self-directed retirement investing in crypto. But yeah, you'd probably want to double check with your tax advisor on that. The alternative would be, and this I think would be a lot easier, is potentially easier, liquidate that Bitcoin investment, turn it into cash, and then buy property with cash. I'm not sure you need to go through the hassle of, if it is a hassle, again, it's not my expertise, of using the Bitcoin owned by the solo 401k to buy real estate. But from a can you do it perspective, I don't see why not. I mean, what's the difference between that and me using Bitcoin that I personally own to buy real estate? It's kind of the same idea. It's just for the 401k. Yeah.
Okay, this question is from David. My wife is interested in a possible joint venture project. Can a checkbook IRA be used as an entity, a separate entity formation? Best practice strategies formation would be appreciated.
Well, yeah, thanks for the question. Yeah, I mean, people use their 401ks and IRAs to invest in joint ventures all the time. It's absolutely allowable, no problem. Usually it revolves around real estate. Sometimes another LLC is created, sometimes not. It just depends. I don't know what you mean by can a checkbook IRA be used as an entity, a separate entity formation. That confuses me a little bit. What you couldn't do is, if you have a checkbook IRA LLC, you could not modify that LLC to add another owner. You couldn't do that. Now, your checkbook IRA LLC could invest into another LLC. That's totally fine. People do that all the time. But as far as the existing one, it's not going to be modified. And furthermore, if you do a joint venture, let's say it's 50-50, that the amount of income and the amount of expenses shared has to be pro rata throughout the life of that investment, and actually whatever that additional entity owns, that LLC or joint venture, if you will. So if there's a roof replacement that needs to be done and it costs $15,000, the IRA needs to put in $7,500 of that. All right. If there's income of $15,000, the IRA gets $7,500 of that. So it just needs to be shared pro rata. So I'm hoping that answers the question. But again, if you're here, then please feel free to clarify something in the chat.
Okay, our next question is from Sai. What are the self-directed IRA benefits over solo 401k?
We probably peppered in the answer to this throughout some of the questions that we answered already. Trying to think of any that I may not have addressed directly. Let's see. You don't have to be self-employed to have an IRA. That would be a benefit. If you have a minor, it's easier for a minor to have an IRA once they have earned income than it is for them to have a solo 401k. Solo 401k requires self-employment activity, while a minor can be self-employed, babysitting, mowing lawns, whatever. Um, and technically you could have a solo 401k for that. Or if you're like me and you're self-employed, you can employ your um, you can employ your can everyone hear me okay?
Not sure if it's just on my end, but I think Brett might have froze.
Okay,
Okay,
Raymond can
yes.
hear me. Okay,
We'll
I'll
see
keep
if he
going.
can join us back here. I'm not sure if he's having difficulty on his end also. Just give
No,
us one moment here.
no, I'm asking people. I can hear you fine, Natalie. All right, thank you everybody for clarifying that you can hear me.
Okay.
So I will keep going.
I do have people confirming in the chat that they can hear me and not Brett. Sorry for...
I think they can hear both of us, Natalie. Can you hear me? All right. So I lost my train of thought. I don't remember what I was asking. Sorry, everybody. Yes, just fine. Maybe. All right. Sorry, we're chatting elsewhere. Oh, Michael can hear me, but not Natalie. So, I don't know. Yeah, I don't know. I think it's on your end. Seems to... I'll keep going through these questions in just a moment, guys. Okay. So, give me just 1 second here. So, sorry, I have the questions. And again, I totally forgot what I was saying about that last question. But let me go back up. Oh, so benefits over sold for. Oh yeah, if you're like me and you're employed, self-employed, then you can actually employ your children, and then they can have earned income, even if you give them a W-2, and then they can contribute to a Roth IRA. And by the way, Roth IRA, I just opened up Roth IRAs at Vanguard for free for my children. We're not really interested in investing in alternative assets, so it doesn't need to be self-directed to begin with. But yeah, that's what we're doing. So earned income, and if they, by the way, talk to your tax advisor, but if they fly under the radar of the standard deduction, which is like 16 grand for the IRA, then you can actually, they don't pay any taxes ever on that money, which is super cool. Okay, all right, I'm done. I could talk about that a bit more if someone wants to hear more, by the way. All right, let's see. My wife is interested in possible... Okay. Anything new this year? Yes, I do have some new stuff to share this year. Mohammed, I see your question. We'll circle back around. The income limits are going up. Okay, so 401k, 403b, 457 is actually 24,500 now for the elective deferral. It's going up. Let me share my screen, actually. This will help everybody on the call. Screen 2. Okay. So, all right. Hopefully everyone can see that. So $24,500 going up $1,000. The catch-up contribution is going up $500 to $8,000. And then the total contribution limit for under 50 years old is now going to be $72,000. So that means that the total contribution, if you're over 50 to the solo 401k, is going to be $80,000, which is amazing. By the way, just as a general rule, if you're married and both spouses participate in the solo 401k, then the numbers double. You, as a married couple, could put in $160,000 a year into your 401k, whether it's Roth or traditional or a combination of the two. Imagine if you could incur the tax bill of $160,000 and still have enough money to live on from your self-employment income, assuming that's your bread and butter, and put in $160,000 a year in Roth. Do that for 10 years. Do that for less than 10 years, and you have $1 million in Roth funds, and invest it, meager 10%, 8%, whatever. Man, you could have many millions of dollars over a short period of time in Roth. But anyway, those are the possibilities. IRA contribution is going up $500 to $7,500, and then the catch up is for IRA is going up $100. How they come up with some of these numbers sometimes, I just don't get it. Anyway, wanted to share that with you guys. So, okay, next question. Let's see here. So yeah, Karen, thank you for asking. Anything new this year? By the way, that's not this year, that's next year. So there's your answer. Bobby asks, are annual contribution limits and rules the same for each, the tax deferred and Roth contributions? I understand these need to have separate accounts, but are they considered 401k funds? So yes, they are. If you're doing this inside of a solo 401k, then they are 401k funds. The limits and rules for each of the tax deferred and Roth contributions, yes, $70,000 is the max if you're under 50. Okay. $77,500 because there's a $7,500 catch up on the employee side, if you're over 50. Patrick asks, what is the best way to invest in Bitcoin treasury companies using the solo 401k account? Also steps and requirements to borrow from okay. Patrick, I am so sorry. I don't know what a Bitcoin treasury company is. I don't know what that means. I don't know. But there's nothing, as long as it's not involving a prohibited transaction, there shouldn't be anything keeping you from doing this. And by prohibited transaction, I mean investing with a disqualified party like you and your immediate family, which would be prohibited transaction, of course. There's nothing stopping you from using the money to invest in a company. But yeah, I'm sorry. I don't know what Bitcoin treasury company is. When I hear the word treasury, I think of the federal government. I'm not sure if there's a relation there, but anyway, if you're here, feel free to type in the chat, clarifying. And then the steps to borrow. So the solo 401k does have a participant loan option. You can borrow up to 50% of the plan assets, not to exceed $50,000. We do have step-by-step instructions on our client portal to be able to do this. And so essentially is figure out what your plan is worth, right? The assets. If it's $100,000, then you could borrow up to 50, and then you essentially would just fill out a loan application and sign it as the borrower and the plan administrator, because you're both, and then put in the dollar amount of the loan, the interest rate, which is always prime plus 1% with our plans, and then also print out, and then the payback period, right? It can be amortized up to over 5 years. No prepayment penalties. And then you also need to pay back monthly or quarterly, and you need to print out an amortization schedule. Okay, so those are the steps, and you could literally just write yourself a check from the solo 401k, or do a wire transfer, ACH, whatever. Typically, you're doing this from a checking account, but theoretically, the money could come from Fidelity if you have a brokerage account for the solo 401k as well, or Schwab or whatever. So, and then again, step by step in our client portal on that. Okay, Robert is asking, can I refinance and obtain cash out for a new loan on a potential duplex property purchase to be made with an inherited IRA on a seller carryback initial purchase that I am considering. That is a mouthful. I love it. Thanks, Robert. Let me flash that on the screen. Okay, so let's take these one step at a time, all right? Can I refinance and obtain a cash out for a new loan on a potential duplex property purchase? Yes, but this has to be owned by the IRA. You can't do this with personal assets or cash or anything else. All right. You have to. Can you hear me, Natalie?
Yes. Can you hear me?
Okay. Yeah. There's a little bit of echo on my side when you popped back in for some reason, but all right. Can I refinance? Yeah. You can. There's Natalie with audio. Thanks, Michael.
Thank you.
Again, so let me back up. The IRA owns. Oh, that echo is really bad. Hold on. Yeah, maybe if you just, now it's gone. Maybe if you just keep yourself muted while you're not talking. Thank you. The IRA would have to own this property for this to work. Okay, so let's back up a little bit. I have an inherited IRA worth $100,000. First of all, if it's a non-spousal IRA, it's just inherited from somebody else. It's always an inherited IRA. Can you self-direct it? Yes, but it can never turn into a solo 401k. It can't transfer into a solo 401k. It has to stay an IRA. So now it's an inherited, self-directed IRA, whether it's Roth or traditional. It has to be liquidated within 10 years. Okay, unless you inherited it, before that law became in place, which I don't remember. That's like 2012, I think, or something like that. But anyway, so you have this inherited self-directed IRA with $100,000. That IRA can own a property or invest in a property, and then you could do a cash out refi on that. 100%, no problem. But you can't mix personal with this IRA. That's not allowed. On a seller carryback, seller carryback is allowed. That's fine. As long as it's a non-recourse loan in both cases. The cash out, refi has to be non-recourse, as well as the initial purchase as well. I suspect that, Robert, you're asking this in a way that would create a prohibited transaction, which is not a good idea. So, all right, next we got Bill. Go ahead, Natalie.
Okay, sorry for the tech issues, but a question from Bill is, how do I report RMD from my solo 401k plan?
Yeah, Bill, good question. First off, you're going to want to calculate the amount of the RMD. And RMD age currently is 73 years old. I haven't heard of that changing yet, although I would imagine at some point it's going to tick up a year or so. But 73 years old, you need to take RMDs. If you have alternative assets within these plans, it's going to be important that you plan ahead for the RMDs because typically, if you have cash in the plan, it's not invested as aggressively as you would like, right? Like real estate or private lending or whatever. The problem with these types of investments is that they're illiquid. You can't just sell, the front door of the property to satisfy an RMD. You could distribute the front door to yourself, more on that in a moment, but you can't sell the front door. Like, as if you just had stocks, right? If I have 100 shares of S&P 500, I could liquidate some of the stocks, turn it into cash, make a distribution for the RMD, satisfy the RMD. Can't do that with alternative assets. So you're getting a bonus here. I know that's not your question, but as you get closer to RMD age, maybe 2-3 years before, depending on what assets are in your self-directed account, it's important to plan ahead to have enough cash in the plan to satisfy the RMD. The alternative would be, getting back to my somewhat silly illustration about distributing a door to yourself, the alternative would be is that you can satisfy the RMD by distributing a portion of an asset to yourself. So if the RMD equals 25% of a rental property owned by the solo 401k, then you can distribute 25% of that rental property to you this year to satisfy that RMD. If you do that each year for the next 4 years, then you own the property personally. Okay. Now, while the IRA or 401k owns part of it, you can't use it personally. It still follows all the same rules as if the plan owned it completely, other than you're now sharing in the income and the expenses with that retirement account. So how do you report it? Well, you report it with a 1099 that the plan's going to issue to yourself in January for that distribution, and then you report that to the IRS as an RMD. But check with your tax advisor on what that dollar amount needs to look like.
Okay, a question from Steven. I have a Roth 401k. Can I buy crypto and hold for gains?
Yeah, absolutely. We talked about that already, so probably I know that was a pre-submitted question, but 100% you can buy crypto and hold, no problem. Typically, you need to choose an exchange to work with. My understanding is there's only 4 that are actually quote unquote registered in the U.S. to be a crypto exchange. Let me see if I can test my memory. Binance, Kraken. I got 50%. I can't remember the other 2 right now off the top of my head. So pick one of those. There's a lot of exchanges out there, so be very careful. I don't want your money to disappear into a black hole. Pick one, buy the Bitcoin there or the crypto there. You can store it on the exchange, or you can store it in cold storage in your possession, as long as that cold storage device is only used for your solo 401k plan. You cannot mix up personal anything on there, crypto or anything else, as far as the keys for the crypto goes. So, but yeah, buy and hold crypto. Lots of people do that. And if you're going to do it, it's kind of a moonshot, right? Might as well do it in your Roth, because now it's just all tax-free as far as the gains go. So there you go.
Okay, a few more questions here from Steven. Would love to hear more about the mega backdoor Roth benefits.
Let's skip that one because we answered that earlier.
Yeah.
Yep.
This one is from Kevin. I opened a solo 401k account several years ago and never did anything with it. Will I be able to put my rental properties into it?
No. Next question. Just kidding. Kevin, anything you personally own, you're a disqualified party. So your plan cannot transact with you. Okay? Your plan can't buy anything from you or your spouse or your children or their spouses or your parents and your grandparents. That would be a prohibited transaction, and that with an IRA, that will disqualify the entire plan. With a 401k, there's an excise tax to pay, and then you got to unwind the transaction. And how do you do that with real estate? It's a big mess. Okay, so no, you cannot do that. As far as having your plan several years ago and never doing anything with it, you should do something with it, or you should probably terminate the plan. I'm happy to talk offline about that, but yeah, it won't hurt if you just start doing something with it.
Okay, from Snehal, how to set up a LLC to be owned by solo 401k trust for real estate purchase.
Well, it depends on what your motive is here. Snehal, hope I'm saying your name correctly. You can't actually, you could have another LLC created on top of the solo 401k if your concern is limited liability protection. I'd be curious to hear what what specifically makes you ask this, but you don't need it. I think, by the way, again, I said this at the beginning, I'm not an attorney, I'm not a tax advisor. If you talk to asset protection attorneys or even estate planning attorneys, the good ones will not tell you typically that you need an LLC for every real estate purchase. That's just overkill. Even with a 401k or personally, you can have an umbrella policy of $1 million or more for just a few $100s a year. You have regular hazard insurance. Those are typically more than enough to protect the property and you from any sort of liability. If you're concerned about liability from you personally to the plan, well, the solo 401k from a creditor protection standpoint is governed by each state. So it really depends on what state the plan owner lives in. That's what's going to dictate the solo 401k creditor protection. So many states follow what's called ERISA law when it comes to the protection, which affords the same type of protection as group 401k plans, but not all of the states. Like California, for example, it's this long, complicated, weird explanation, of course, because we're in California, but it says something about actually I'll just read it because it's even for posterity, if for no other reason. It's kind of interesting. Okay, so here's what California says. This is state exemption for solo 401k from creditors. Does it have it, yes or no? The answer is yes, but only to the extent necessary to provide for the support of the judgment debtor when the judgment debtor retires, and for the support of the spouse and dependents of the judgment debtor. That would be you, the plan owner, by the way, taking into account all resources that are likely to be available for the support of the judgment debtor when the judgment debtor retires. California Civil Code 704.115. Okay, so talk to your asset protection attorney if you're concerned about that. But yeah, typically we don't. To answer your question, Sanal, it's very rare that we would ever create an LLC on top of a solo 401k. It's just not necessary 99.9% of the time.
All right, and then the last question here is from Dan for the pre-submitted questions. What are the year-end filing requirements for checkbook IRA?
Yeah, Dan, thank you for asking. Well, the custodian will contact you usually late November, asking you to report the value of the plan so that they can issue the 5498. That is really the only filing requirement. Other than making contributions, of course, that'll be reflected as well. And then that'll be reflected on your tax return. And if the IRA owns any sort of taxes, but this isn't due at year end, the IRA would have to submit a 990T tax return, and that's due I believe April 15th, and you can even extend to October 15th. So check with your tax advisor on that if your IRA owes a tax. But for normal plans that are invested passively, it's really just the annual valuation that you have to do.
Alrighty. I know we did have some questions in the chat. Brett, my chat did reset since I lost connection. If you don't mind going through them.
Not at all. Okay. Ven asks, can a solo 401k invest in the stock market? Absolutely. You can open a non-custodial brokerage account at the brokerage of choice and move money from the solo 401k, typically checking account, at Solera as an example, and then you can invest in stocks, bonds, mutual funds that way. We have instructions step by step on our client portal, by the way. Let's see. I think you answered Greg's questions. How do I set up a call to ask questions? I want to know how to pay myself salary so I can contribute to the 401k, but my income is periodic, commission-based, and is consistent. Salary is not possible. I have an investment where I want to send funds. How to do this? Well, first of all, Greg, any sort of plan, any sort of self-employment setup can sponsor a solo 401k plan, as long as you don't have, like I said earlier, full-time W-2 employees outside of the business owners and their spouses. So you can be a sole proprietor. You don't have to run payroll. If you're S Corp filing, then you have to run payroll. All the contributions are based on the W-2 for the year. So it really just depends on how your business is set up. If I pay tax, Ven is asking on solo 401k investment, how do I decide whether to convert to Roth or a cash investment? Roth grows tax-free, but cash investment can utilize the bonus depreciation. No, on both of those. The solo 401k investment there are no taxes, tax deferred or Roth, while it's in the plan. So there's no depreciation to take advantage of, because there's nothing to depreciate. There's no taxes to offset. If I pay tax, how do I decide whether to convert Roth or a cash investment? I'm not sure I understand that, Ven. I'm sorry. How do I decide whether to convert to Roth or a cash investment? Roth grows tax-free. I'm not sure what that means. Greg says, I am 63 and my wife is 68. I am running out of time to use the mega contributions. Yeah, Greg. I mean, it may or may not make sense. It depends. Sometimes people want to maximize their Roth for their heirs. Sometimes they want to maximize their Roth for their own retirement, or both. It depends. I'm happy to talk through that with you if you ever want to chat. I made contributions to after-tax contribution to solo 401k and then rolled over to Roth component. Okay. This is keyer, by the way. Now I would like to roll over to Roth Schwab individual 401k plan from solo 401k Roth component. What is the process for this rollover? Well, you have two options. One, if you're going to maintain the solo 401k, it's a 401k Roth. It's a Roth 401k, not a Roth IRA. So I would keep it that way and just open a brokerage account at Schwab, non-custodial, non-prototype brokerage account at Schwab. They call it a CRA. And then you can invest in Schwab using those funds, and the money stays within the solo 401k. Otherwise, your only option is to transfer them to an IRA at Schwab. But now they're Roth IRA funds, and now they're always stuck as Roth IRA funds. So if you ever want to liquidate those stocks or mutual funds or whatever they are at Schwab, they're stuck as an IRA. You can't go back into the 401k. So if you want to save money and then buy another piece of real estate in your solo 401k, you're not going to be able to do that. Up to you, but understand the implications. Let's see. I'm scrolling. Muhammad says, my wife has solo 401k and we are both applied. I'm also contributing to the solo 401k along with my wife. Okay. Can this business have 1099 employees? Yes, it can. Or we cannot have any employee. No, 1099 are not employees. They're independent contractors. But yes, that's fine. Can you explain Roth solo 401k to third-party Roth? This is from Kier. Wait. Can you explain Roth solo 401k to third-party Roth individual 401k conversion like Schwab? Okay, I think I addressed that already. All right. Let's see. Oh, wait, no, that was us. Okay, Mohammed's asking, if solo 401k owns rental properties, can the solo 401k have a car for managing the properties? I mean, it could, but who's going to drive that car? Because it can't be you or your spouse. So I don't know why you would do that. Are you going to provide a car for your property manager? I don't think so. So that I don't think makes sense. Oh, when did that question from 1154? Oh yeah, he really did join late. All right, let's ask. How to set up an LLC owned by? Oh yeah, we did ask that. I don't have time to answer it again, but you can check the recording. I answered it about 15 minutes ago. So Sneehall. Sorry if I'm saying that correctly. All right. Hey, thank you so much, Natalie. Really appreciate it. Don't worry about the technical difficulties. I took over and just kind of kept going. So it's all good.
Thank you. Appreciate it. Yeah, thank you everyone for joining. We love doing these Q&As. We do have a lot of questions that are submitted. So our next session is going to be in 2 weeks. It'll be on December 1st, same time, 11 a.m. Pacific Standard Time. So we do look forward to you joining next time. And if you have questions in the meantime, please reach out to us. We can always schedule a call with one of our experts.